So welcome everyone. Welcome to this Market Thursday, 9th of September, 8 o'clock here in London. So thank you for all of you who are joining tonight, and for those of you who will be joining later on YouTube. As usual, as a quick disclaimer, this webinar is not for investment advice. This is purely for information. So I do not take responsibility for losses incurred by viewers. So please do your own research, and I might have or might have not any position that I'm talking today. So my career, so that picture was taken a long time ago when I was still young and full of energy. I started in 2000 in Paris as a cash equity trader, working for Pierre Charon Gestion and then another asset manager in Paris, where we had roughly 50 million euros. 2004 to 2008, worked for a hedge fund here in London called Griffin Capital Management, where we had asset under management going from 150 to 600 million. And the overall company had more than 2 billion, roughly 3 billion at the top. I joined Infinity Capital Market in 2009, which is the UK branch of First New York, who is doing prop trading across asset classes, many strategies. I did that from 2009 to 2018, doing some mentoring for another company from 2014 to 2017, launched my own mentoring program in 2018. Launched a 4x4 video series a couple of years ago. And we started prop trading in January of this year for Infinity, so back in the game. So this is quickly my 20 years career. So today, what are we going to be doing? As usual, we're going to be talking about the 4 asset classes: stocks, credit, commodities, and FX, looking at some macro charts, the flows into equities. We're going to be discussing the Fed's expectations. Why? Because the Fed is going to be talking in a couple of weeks, and looking at the job market. That's something that we covered many times, but I think it's worth doing it again. And we'll be looking at the S&P 500 sales and the EPS for 2020, 2021, and 2022. Why? Because we are going next into the fourth quarter in a month's time, mid-October. And more importantly, starting in September, investors very often will be looking forward into the next year. So that means 2022. And I think it is worth, that's something that we do during the mentoring program. During the first session, we look at the expectations and what the market is pricing and what the market is paying, investors are paying in terms of PE, for instance, sales. And we're going to be taking the example with the S&P, which is the benchmark, the US benchmark. Quickly, in terms of catalyst and what has been happening. So we had the ECB today. As usual, FinTweet and Twitter love these days, because there's a lot of bashing around the monetary policy, bashing around Europe, and the top cherry on the cake, bashing around the French with Lagarde. So it was a bit of a boring 1 hour call, but more or less ECB will be starting tapering. They use another word, which was, I can't remember what they were using. But more or less, instead of doing 80 million euros every month, they're going to be tapering by 10 to 20 billion. So that's roughly 60 billion. So this is still a big number. So more or less, central banks are telling you that they are still in the game, and they're going to be in the game for quite a long time, and they'll be data dependent. So the data dependent, we're going to be hearing exactly the same in 2 weeks. So catalyst, in 2 weeks' time, we get the Fed meeting. Next week, we get the, on Wednesday, we get the VIX expiry, and more importantly, on Friday, the big quarterly expiry, where we get the options, the futures, so the quadruple witching, which is in reality is a triple witching, the index rebalancing. As we covered during the previous webinar, so there's another YouTube video from a couple of weeks ago, We look at the expiry and how the S&P has been doing around this expiry. Over the last 4 expiries, the S&P has been pretty weakish in the OPEX week. And as we discussed last week, that means 2 weeks before the OPEX, that is statistically a strong week, and it was a strong week as well, so it was a positive week. So the pattern is more or less the same. As you know, and as I've been covering for many months and months, market is more and more driven by options. So be familiar with the market structure and the impact of those options. Otherwise, looking forward, we get as I said, the earnings season in a month's time. So that gives you a bit of time. And everyone will be looking in the next few weeks and months if we could have like this Christmas rally, because it might come soon. That will be the talks that will be coming very soon in making the headlines. So in terms of price action and how the assets have been doing, the picture is very similar to a couple of weeks ago, which is stocks across the world have been up, especially for developed countries. We know that emerging markets have been struggling a bit more. First with China, we started to discuss the slowdown of China based on lower credit. I think it was from May we started to underline this. So China was a bit weakish, and the whole region of Asia, especially more affected by COVID, versus developed market. In terms of currencies, again, a lot of noise, not much happening. Euro dollar trading around 118. So the world is full of dollar, but actually is full of any central bank's currency. So there is a lot of liquidity into the system, which is helping the risk ongoing. It's really the picture is the same. WTI actually today was an interesting day with WTI trading between 67 and 70 for the swing traders. That was an interesting day. So we had the Chinese headlines saying that they were releasing some reserves, but actually that news came out a couple of months ago. It was just making the headlines. So China and other countries are a bit worried by inflation, and are trying as much as possible to limit this inflation, those commodities inflation, by releasing the reserves and putting as much supply as possible, because inflation with the supply chain is creating some bottlenecks in the system. On the week to date, you can see that Japan has been very strong. On the other hand, Brazil has been pretty weak. So we're going to be looking later with the price action technical analysis, how the Nikkei, the topics have been doing. Why? Because the Prime Minister has no resigning, and that there is another leg up in the risk appetite in the region. The Bitcoin trading around 46,000, 47,000, coming down 10% from the recent highs. More volatility after the strong move from 30,000 to 50,000. Otherwise, as you can see, again, this is quite a boring 6 months, 9 months for currencies. So if you started your career as a retail trader, trading FX, like probably 80% of you, that has been quite a boring and unsuccessful 6 months. Very much, pretty much quiet, nothing really happening. S&P sector performances, as you know, the 11 sectors of the S&P, year to date, similar picture. More interestingly, on the week to date, as you can see here, it's more the cyclicals that have been underperforming the overall market, industrial materials. That is, and you can see that the IT, that the FANG, Facebook, Amazon, Netflix, Google actually have been outperforming the S&P by 2 to 3% since the start of the month. So there is a lot of allocation and flows going into technology, and there has been some worry about the growth around the world. Something that we discussed a couple of weeks ago with the slowdown based on the variant. But in terms of price action, this is exactly what has been happening. The cyclicals have been a bit struggling. We need to put everything with a pinch of salt. Why? Because the S&P is only 1% or 1.5%, not even, from the all-time high. So you know, a correction of that magnitude is just a farce. It's just like everything is still in a very bullish mode for the time being. As you know, I like to, for those of you who are in Europe, and not only, if you can, not only be looking at the US, but widening your universe, looking at Europe. So here, this is the Stock 600, looking at the sectors. And as you can see here, the picture is very similar with technology, very much outperforming the market at 3% plus, where the Stock 600 was down 1% on the month. And on the other hand, we can see that the basic resources, auto parts, you know, everything that that has been suffering recently from the supply chain. Next one, looking at the bonds. So the bond market, yields going up a bit, but actually it's coming down back, sort of a bit going sideways, with still bonds going up slightly. The VIX, so it's higher today, is at almost 18.5 to 19%, above the 16%. What is interesting with the volatility, and that's something that we covered, that's something that cover in the 4x4 video series, which is looking at the implied volatility through the VIX and looking at the realized volatility or the historical volatility. You can calculate it, or you can go on the CBOE or the S&P website. And historically, by definition, investors overpay, or you're going to have a higher implied volatility versus historical volatility, because investors pay more to hedge themselves. What has been interesting over the last couple of months is actually the historical volatility. The realized volatility has been very low. So if you look at the 30 days, we're talking on the S&P around 10%, whereas the implied was on 16, 18%. So the differential was around 8%, which is pretty big. Why? Because there is a lot of activity with options, there is a lot of hedging, and there is as well a lot of upside calls, and upside calls on many names. So despite the VIX being quite high, or you could say that the VIX is pretty high versus the realized volatility, which is extremely low. So the market underneath is pretty boring. That is true in the US, pretty true in Europe. If you look at the S&P, there are names that, as always, are moving quite a lot, but overall the realized volatility is pretty low. Next chart. Now I wanted to always add a bit of slides of, you know, some topics that the market will be discussing. We know that in China there is this Evergrande story with the huge leverage of this Chinese company, and we are all wondering how it's going to unfold. Interestingly, in Europe, electricity prices have been on the rise in 2021, so this is not new, but recently there has been another leg up. So one of my mentees is now an electricity trader, so I'm lucky to have a good conversation with him. Clearly there is an issue with the wind, not enough wind in Europe, which makes so you get a deficit of 10 to 15% of electricity. You get as well not enough gas coming from Russia. So a lot of drivers, and we're starting some plants, electricity plants, but overall you can see here, this is the prices for in Germany the megawatt hour for the next day. And that is interesting because we are coming into winter. We know that the elections in Germany will be coming on the 26th of this month. So in terms of purchasing power and the ability of the European consumer to consume more, there's going to be an issue here. So that's really something that is on top of my watch list of this effect on the price of electricity prices on European consumption, not only in Germany, that's the same in Spain, that's the same in France. If you think that even if we have a mild winter, that's going to be an issue. If we get a bad winter, that could be really bad. So looking at losers, the potential losers, that could be industrials as well, because the cost of electricity bills could move up drastically. So this is more for global themes, ID generation. I'll let you do the work. In terms of the picture, last time we looked at the PMI manufacturing, now looking at the world PMI services. As you can see, we peaked 3 or 4 months ago. So all the indicators are now telling you that we peaked a quarter ago. Question now is, are we going to be staying at this high level, or are we going to carry on further down? August was not a good month based on the COVID variant spiking in the US. We will have to see soon if things are stabilizing or normalizing both in Europe and in the US. Why? Because the PM services, I think, for the global is at 52% after being at 55%. So quite a slowdown in terms of leading indicator. Another chart in this chart is coming from the sources Strategas, and I found an article interesting on the FT, which tells you about the cumulative daily equity ETF flows, tells you about how much money is coming into the equity market versus the other years. You can see in green in 2021 how much money is coming. So there is a ton of money floating into the market. Which is making all these ETFs and then obviously the underlying, which are the indexes and the stocks going higher. That is literally twice what we usually have. So there is a kind of hoo-ha-ha phase where everyone is going all in the equity market. That is clearly something to watch. Why? Because the market, which was already driven a lot by ETFs, is even more driven by ETFs. And as you can, maybe some of you noticed over the last 10 days, if you look at Apple and the number of options, and if you look at the performance of the S&P, I made the calculation, probably around 40 to 50% of the performance of the S&P over the last 6 weeks was driven by the top 5-6 names, Microsoft, Apple, the 20-25%. So there is a lot of concentration into a few names, and it keeps on going. So that means that the market structure is more and more into the extreme, and I strongly advise you to look at the ETF flows. Look at ETF.com, which is a good website to do it if you don't have access to more product. Let's go into the price action. Then we're going to be discussing the Fed expectation. So I'm going to be starting with the VIX, which is my way of looking at the volatility, not only mine, but so we have been trading between, and you can't be really trading the VIX like this and looking at a chart, but between 16 and 23%. As I said, pretty high level if you consider that we are at 1% from the all-time high, and the realized volatility is actually that low. If you look at the S&P futures, the picture is more or less the same. We are still trending. In terms of level, it's not only because this is the support here, but the 4480 on the future and the S&P is a pretty significant level. Why? If you do a VWAP, meaning that if you look at the average of contracts that have been trading recently, a lot of contracts were traded between 44.75, 44.85. So this is a strong support. The market so far has only been down 1 to 2% from its highs, even where we had the hiccup from the expiries. But short term, this is the level that I will be watching for market condition to turn. Something that I mentioned before, which is the Nikkei up. So that's for the Japanese index. Strong move, breakout on of this flag, of this resistance, whatever you call it. So very strong move, 6% over the last 5 sessions. That's the same with the topics. Now we will be testing, and we are testing the all-time highs soon. Very interesting. And on the other hand, we get, as I said before, Brazil, where Brazil doesn't look that great. Technically, looks a bit dodgy. We are making new lows, which is not a good one. So emerging market price action of Brazil is really telling you something. I'm always thinking about, stock like Bud, ABI, which could be impacted. Also look at companies that have significant exposure to that region. I want to be discussing a bit as well on more specific single names. So Microsoft that we discussed. So let me go into the regular chart. So it tested the top of the range, now consolidating over the last 10 sessions. Really watch all these big caps, big weighting of the S&P, like Apple, which has been testing. Apple's got a big meeting next week, launching apparently new products. There were tons of options, call options expiring tomorrow, 155, 157.50. Check what are going to be the open interest coming into the expiry next week. Interestingly, and that's something that we discussed a bit on the community, which we started to see some profit warning. So we saw a profit warning from PPG, another one from AkzoNobel in Europe. So the whole space and from Cherwin as well has been warning on supply issues, on commodities prices. And interestingly, as you can see, it's very similar actually to the top of we saw in the PMI. We topped in May, June on many of those names, and now we have been coming down. So if you look at PPG, we are down roughly 20%, 15 to 20% from the highs. So the market was pricing issues, was pricing some warning. And actually now, if you look at the price today, we are back to the pre-warning. So a lot of warnings on those names have been priced in. Other names that if you do the mentoring over the last 5 years, everyone was coming with Sam as a long Boston Beer, and Boston Beer keeps on coming with warning because one of their part of their businesses, which is Seltzer, has been struggling. And if you look at other names like TAP or names like ABI, but the chart tells you that there is still some way to go on the downside. So be careful on playing the contrarian thing here by buying, thinking this is the bottom. When you get such a gap on the downside or the upside in significant volume, there is very often what we call the earnings momentum, where if you look here, the stock came down 20% and carry on. And actually today they come with another profit warning. Another one that I want to discuss, which is the industrial and ETF. So exactly as we discussed again, we had the top in May, June in the industrials, materials, the whole space of, world reopening, strong cyclicality. And actually, if you look at the PMI, the cyclicality is the same. And now we have been consolidating since then. So breaking the trend that started from the bottom of March last year. But literally, we got 3 or 5 months of consolidation now. I have to be honest, my P&L looks pretty much the same over the last 3 months, so flattish as a pancake. I find it pretty hard to find to play the momentum here because the industrials, have been toppish and not really happening. So cyclical have been doing the same over the last 3 months, and we know the story since last year. And now playing the technology, those leaders, to me is pretty hard because they are really driven by options and really driven as well with very extended valuation, which is kind of too much of playing the game here. But I wanted to share those charts. And another chart that I think is interesting to me, which is always one to watch, which is UPS. So UPS had its massive move up at the start of May, almost the end of April. Gap, follow up. Now we're testing this move. So that's one to watch to see if we're going to close the gap, what's going to be the price action, because clearly this one tells you a lot about how the US economy and the world economy is doing. You can argue that Amazon is taking some market share and UPS and FedEx are struggling based on this Amazon entering the market, but still try to find those names that could be good indicators. I don't want to do too much of FX and I don't want to do too much commodities because the picture is more or less the same. So we're going to be jumping back into the Fed expectation and the slide. So Fed expectations, as I said, in 2 weeks, we get the Fed meeting. We had the ECB today talking and doing some tapering. So actually, for the first time in a long time, the ECB is doing something before the Fed, because normally the ECB is always doing something 6 months after the Americans, the Fed. But today, the ECB said, in other words, that they're going to be starting to do tapering. But because they want to be very cautious, they say, oh, we don't name this tapering, but we're going to be reducing it. And if we have to do more, we have to do more. So this tapering could quickly come back into the QE infinity if the numbers are not good. But in terms of the Fed balance sheet, this is still the picture where we had the massive move around March, April last year, when we had this massive jump. Then they are still doing 80 billion months of buying treasuries and 40 billion of MBS. There is the calendar that you can find on the Fed of New York on the daily buys. And actually, you can see almost that the S&P is moving when they are doing it during this 20 minutes to 30 minutes window. But that's the picture. So either the Fed or the ECB strongly and actively buying bonds. And here, this is the Fed history. So if you are looking on YouTube, I've done a Fed a QA explanation in less than 7 minutes, and I've been using this chart, which actually I think it's pretty good, telling you how the S&P has been behaving over time based on the history. So in red we can see the end of QE, the end of Q3, and end of Q3, and if we go into the next slide, the chart is going to be even more telling. where we started the QE4 infinity, you can see the move of the S&P. So huge move. Having said that, when the Fed last time in 2013 started to talk about tapering, over 6 months the S&P did pretty okay. So tapering doesn't mean, you know, they stop accommodation and suddenly the S&P will come down by 20%. So be careful on those things. We are still talking about 120 billion, which is massive. When the ECB goes from 80 to 70 or 60, that is very significant, and that means they are still buying a lot of the treasuries, or I should say the bonds that will be out there, keeping in mind that as the economy is restarting, that is lowering the level of deficit, meaning that the ECB, the Fed, the Treasury doesn't have to print probably as much as they used to. But I would like to talk about Fed expectations. So you can go, the first thing that you can do, is go on the cmegroup.com website, where they're going to give you, depending here on the when is the meeting, how the market is pricing the probability of the Fed cutting or hiking rates. So here, this is for the one in a couple of weeks on the 22nd of September. As you can see, 100% chance of the Fed not doing much. If we do the same and we move forward in time and we go on to the next year, on the 14th of December 2022, here the odds are not the same, where you can see the market is pricing pretty much higher chances, to say the least, that they're going to hike by 25 bips. So we get, so the accumulation will be 50% more. So here, sorry, no change, hike 50. So that's a 50-50. What I like to be checking, and this is something that I discussed in the past over and over, but I thought it was worth doing it, which is looking at the euro-dollar futures and what the euro-dollar futures are pricing. So last time we discussed it actually was almost 3 months ago. So that was in mid-June. And we looked at what the euro-dollar futures were pricing. So if we look at the December here, that's the Z2 at 99.55. That means literally the versus what we have here. That means the market is pricing a rate hike in December 2022. But if you look at the differential that we have from today, 99.57, so it's more or less the same. And actually, if you look at the December 2023, here you get 99, whereas in a couple of months ago, you had 98.92. In other words, that means that the market over the summer has been less aggressive of the Fed hiking rates in the future, at least until 2023. There has been some, if you remember, in when was that? In February, March, everyone was saying the Fed has to do something quickly because of inflation. And actually, the expectations have been coming quite a lot. So the Fed is using both yields, rates, and quantitative easing. So quantitative easing, they're going to be reducing probably like the ECB. I don't have the timing because I don't talk to the Fed chairman very often, but they're going to be doing tapering for sure. But in terms of hiking rates, that's not going to be happening as soon as the market was expecting three months ago. So you could expect nothing happening in the next 12 months from the Fed. So use the euro-dollar futures. You can go on investing.com. You can go on the several websites. You're going to have the data, and that's going to give you the Fed expectation from the market. Next one, as I discussed during this introduction, I want to be talking and covering the S&P 500 sales and earnings. Why? Because we were in September. Soon if we are investors, we are looking 3 to 6 months in advance and what's going to be the picture in 3 to 6 months. So that means in terms of valuation, you'll be already looking at the PE of the earnings of any ratios that will be 2022. And that means we have to be looking now at not only the earnings season that will be starting in a month's time, but as well, what the market is forecasting for 2022. So I look at the pictures. So here I've been using data from Bloomberg and looking at the year-on-year sales. And you can see that the growth has been pretty much the same. Having said that, here we get the jump over the last couple of years. So the market and should I say more the US and the US companies in terms of sales have been pretty significant. Year on year, 14.4% in 2021. So that is the expectations. We only got 1 quarter left, and for 2022. The market is expecting 6.4% next year. On average, since 2000, if you look at the last 20 years, sales are going up for the S&P 500 companies by 3.6%. So think about, the US GDP, which is growing between 2 to 3% on average, and the world GDP, if you take the emerging market, between 4 to 5%, and if you take a ratio of 80% US, 20% non-US, or even 50-50, that makes sense to have the 3 to 4% sales growth. But that means next year 6.4% is going to be significantly above the average growth over the last few years. What I do these days and what I've been doing during the mentoring sessions is to compare companies' numbers. You should be comparing the numbers between 2021 and 2019, keeping in mind that 2020 everything is distorted. So try to look at 2019, 2021, and 2022, and what has been the growth in terms of top line, meaning sales, and the bottom line over that period. In terms of earnings, so this is the earnings since 1993. Since 2000, on average, the earnings have been growing by 5.8%. Where with the median at 7.4%. You can see the growth here. So I always say the same when I do the mentoring. The growth over 2018 and 2019 was pretty big. Why? Because the Fed administration reduced the corporate tax rates. But then in 2020, obviously, we had the numbers coming down. So are we going to go into the next slide to explain what the market is now forecasting? So S&P 500 earnings, 2019, $151.74, 2020, $124, 2021, $203, and 2020 at 220.91. So if you look at the forecast for next year is plus 8.7%, which is actually very much like the average growth of the S&P earnings. And if you like sometimes to look at the PE of the S&P, and if you take the S&P, which is trading at 4,500, that gives you a P of 2021 at 4,500 slash divided by 200.3, a P of 22 times, and a P for 2022 at around 20 times. So P, sorry, let's go back here. So P at 20 times, historically, P of the S&P is around 15-16 times. We know that because of what we just covered, which was the central bank's policy, we have higher PE than usual because the cost of money is much lower, and the equity premium is much higher. So this is the picture now. Actually, if you think about, if you compare 2019 to 2021, that's a $50 jump. So that is a huge move, and you might scratch your head of thinking, okay, if we are in a COVID, if we had COVID, how those companies have been doing so well. We know that first that operating margins are at all-time high, so they are above 14%. We know as well that the tech companies, which are getting bigger and bigger in the S&P, have been printing money. So if you think about software, if you think about Microsoft, if you think about Apple, if you think about Google, and actually I checked, so that's a chart that should have been checking together. I'm pretty sure that if I ask you the question by how much Google is up on the year, most of you will get it wrong. Google is up 70% on the year, 70%. So really the earnings have been on an absolute tier, helped by operating margins very high. But I think what is important is going into the next slide, which is the S&P 500 corporate tax rate. So I used here a chart from Yardeni Research, which tells you about the effective corporate tax rate now, which is around 10–15%, really coming down over the years, helped by, for instance, the Biden administration and some others, any administration. That tells you why as well the earnings of the S&P have been so strong. But there is a question mark here, and maybe I'm wrong, but I'm starting to look at some debate that we have in Europe during the German elections. We get the French elections coming, but I'm pretty sure that the next debate is going to be the deficits. Okay, and actually you can see in the UK that have been increasing taxes. Interestingly, if you want to go back to some deficit, controlling the deficit, and I know that the MMT policy is telling you that you can be printing as much as possible, but still, if we get the deficit that we had over the last couple of years, and if people understand that effective corporate tax rate in the US for US companies is below 15%, then there's going to be a question mark of how much we can carry on of having those corporate tax rate, and meaning that I've said that 6 months ago already, and that does, the S&P in the meantime is up 10–15%. But remember that Biden was talking about increasing those corporate tax rate. If you adjust to higher tax rates, obviously that's going to have an effect on the EPS of the S&P and the total valuation of the market. And I think if you look at the operating margins that are making a new highs, with the restart of the economy, those operating margins could come down again. So that is for the overall picture of the market. I think from time to time it's pretty helpful to get this big picture, especially for me, as we are waiting for the earnings season, and as well there is no real catalyst in the market and no special situation. So it's more, getting the big picture. So quickly, what I offer, what I do, where I can help you. First, the trading community. This is something that I'm really pushing. Would like all my ex-mentees and all the 4x4 subscribers to go on this community and help all of us trying to bring ideas. I think that can be very productive. People are shy, but I think it's going to grow. So if you subscribe to the 4x4, you're going to have access to the community. If you do the mentoring, that's the same. So the second product is the 4x4 video series that I launched a couple of years ago. Getting an investment process works very well the clients, because I think are happy it works pretty well. And the last part is the mentoring, which is for more advanced retail traders or traders. And you can do it really if you get enough knowledge, in a sense, to make the most out of the mentoring. This is it for today. A bit shorter than usual because there are not that many drivers. In terms of market, again, 4480, we got the expiry next week. As we discussed during the previous webinar, the week going into OPEX is normally bringing volatility. So that there might be some action in the market. Then we get the Fed. And I think this is it for me. If you have any question, please send me an email about the community, about the mentoring, about the 4x4. And I'll be happy to come back to you or even discuss that during a Zoom call. Thank you for joining. I hope you enjoyed that one today, or if you enjoyed it, please comment, like, whatever, that helps. And for those on YouTube later, thank you for watching, and I hope to see you in a couple of weeks. Thank you, everyone. All the best. Bye-bye.